Thursday just reminded every retail trader like myself why gap-ups on earnings are sometimes the most dangerous setups in the market. The S&P rocketed up 1.8% at the open on Nvidia hype, then proceeded to close down 1.5%. That's a 3.3% swing. And if you got caught long at the top, well, you just became exit liquidity for the smart money. Look, if you're short on time or don't want to listen to some random guy on the internet pretending to understand markets, here's what you need to know. This was a classic gap and fade in a thin liquidity environment. QQQ gapped up almost 2%, went on a 5% intraday joyride, then closed basically at the lows on 1.8 times normal volume. That's not random noise, that's institutional distribution. The correction is real, but the trend isn't broken yet. We're sitting right at a decision point, and what happens at 558 to 560 on QQQ will tell you whether this is a buying opportunity or the start of something uglier. Hey, welcome back to the channel. For those of you who are new here, I'm DataCat, and yes, that's actually what I go by now. I used to be a data analyst buried inside a Fortune 50 company. Eventually, I realized I'd rather spend my time with keyboards, data, and, well, making these videos than pretending to care about quarterly synergy optimization or whatever buzzword was trendy that month. Or maybe it's just the same thing. Sometimes I wonder. This channel is about 4 months old now, so we're still pretty early. Hitting that like and subscribe button is my only motivation for now. I'm not here to sell you courses or promise you'll retire in 6 months. Honestly, I don't have the right to brag about things. I just like markets, data, and trying to figure out what's actually happening underneath all the noise. And right now, there's a lot of noise. Like cats, I prefer to observe quietly from a distance, then pounce when the moment's right. Though sometimes I miss, land on my face and pretend it was intentional. That's markets. So in my last video, I talked about how Fed rate cut odds were shrinking, but Nvidia earnings had just sparked this relief rally. Markets were pricing in maybe 1/3 of a chance of a December cut, tech was still expensive, and I mentioned there were looming problems. Consumer weakness, Fed uncertainty, thin liquidity, which all leads to volatility. Well, Thursday happened, much stronger than I expected. And the thing is, this isn't just some random red day. This is a textbook example of what happens when you mix euphoric positioning, thin liquidity, and a macro backdrop that refuses to give traders any clarity. We also got the September jobs report Thursday morning, the one that was delayed because of the government shutdown, and it somehow managed to confuse everyone even more. So today I want to walk through what actually happened, why it happened, where we stand now from a technical perspective, and most importantly, how to tell if this is just a correction you can buy, or the early warning sign of something worse. Alright, so let's start with the hard numbers, because they're kind of wild. And allow me to briefly illustrate the picture first. QQQ gapped up 2% at the open. Everyone's excited about Nvidia earnings. Then it went on this absolutely insane intraday roller coaster, about a 5% range from low to high. And here's the thing, it closed at 585.67. The low of the day was 584.75. So QQQ closed literally less than $1 above the low of the day. Meanwhile, the high was 614. That means it closed around 5% off the high. Oh, and volume? 1.8 times the 20-day average. So purely from a tape reading perspective, this is what we call a gap and fade combined with a bearish engulfing pattern on massive volume, closing near the lows. That's textbook distribution. That's not retail panic selling. That's institutions using the Nvidia excitement as exit liquidity. So why did this happen? The narrative is actually pretty straightforward once you stop listening to the breathless headlines. Nvidia reported earnings Wednesday night, beat expectations, guidance was strong. AI demand still quote-unquote off the charts. The market gaps up Thursday morning because, everyone's conditioned to think Nvidia up equals market up. The gap up on Nvidia became the top tick. Everyone who wanted to buy was already long. The Nvidia excitement gave the smart money a chance to sell into strength. And once that selling pressure started, there was nobody left to catch the knife. Why? You may ask. Why does this sell-off feel stronger than usual? Well, because liquidity is thin right now. For those who are new here or just missed my previous videos, I will explain the full picture later. Now, just imagine how cats will knock something off a table just to watch it fall. That's basically what institutional traders did to retail on Thursday. Except the thing they knocked off was your call options. And then to make things more chaotic, We had the September jobs report hit that morning too, which was delayed because of the government shutdown. And it was the last jobs print before the December 10th Fed meeting, because October data got skipped. So it mattered. Here's what came out. Non-farm payrolls, 119,000 jobs added versus about 50,000 expected. So on the surface that looks strong, right? More than double expectations. Unemployment rate, 4.4%, up from 4.3, highest since 2021. Revisions, August got revised from plus 22,000 down to minus 4,000. July got revised down slightly too. Wage growth, plus 0.2% month over month, 3.8% year over year. That's slowing. So here's the problem. The headline payrolls number looked strong, but literally everything else screamed labor market is softening. Unemployment rising, downward revisions to prior months, continuing claims are up to about 1.97 million, wage growth decelerating. And we know from the benchmark revision earlier this year that the BLS has been systematically overstating job growth in real time and revising it down later. Remember that 911,000 job revision? That was the largest downward revision in history. So from a trader's perspective, this 119,000 number is probably inflated too. It's within the statistical error margin, and the trend underneath is clearly weaker. But the Fed doesn't have October data, so they have to make a December decision based on this confusing September print, plus whatever November jobs data comes out in early December. After the report, Fed funds futures ticked up the odds of a December 25 basis point cut from the low 30s to about 40%. So slightly more dovish, but nowhere near a done deal. A pause is still the base case. That ambiguity, that's what markets hate. And in a thin liquidity environment, ambiguity equals volatility. So let's finally talk about this thin liquidity, because this is really important context for understanding why Thursday's move was so violent. Let's recap. On October 29th, the Fed cut rates 25 basis points to 3.75 to 4%. That was expected. But they also announced their ending QT quantitative tightening on December 1st, 2025. And since 22, the Fed's balance sheet has shrunk from nearly $9 trillion down to about $6.6 trillion. That's over $2 trillion of liquidity drained out of the financial system. Bank reserves have moved from what the Fed calls abundant down to somewhat above ample. That's Fed speak for, we're getting close to the danger zone. The Fed is stopping QT specifically because they don't want a repeat of 2019, when reserves got too scarce and the overnight repo market had a meltdown. So right now, though not in a full-blown financial crisis, we're in this fragile liquidity regime, meaning simply less cushion in the system. Any macro headline, any earnings surprise, any Fed comment can move markets more than usual because there's less depth in the order book. And you can see this in the QQQ data. The average true range is elevated at about 12.9. Realized volatility over the last 10 days is 21%. That's high for a mega-cap tech ETF. Volume was 1.8 times average Thursday, and on-balance volume has been sloping down for the last 20 days at about negative 12.5 million per day. That's persistent distribution, not just a one-day hiccup. So yeah, we're in a thin liquidity, high-sensitivity regime. In simple terms, small shifts in narrative equal big price moves. Alright, so where does QQQ actually stand right now from a technical perspective? Because this is the key question. Is this a correction you can buy, or is this the start of a bigger breakdown? The current price is about 585.7. The 50-day moving average is at about 607. The 200-day is at 542. Both are still rising. The golden cross is still active and the longer-term trend is still bullish. Price is about 3.5 to 4% below the 20-day EMA and 50-day SMA and about 8% above the 200-day. Drawdown from the 52-week high is about 8%. So this is still a sharp pullback inside a broader uptrend, not a broken trend. Yet. Momentum indicators are oversold. RSI is at 35.3, MFI is at 28.2, stochastics are at 10.7 and 15.1. Those are deeply oversold readings. Bollinger Band Z-score shows the price is more than 2 standard deviations below the 20-day mean. So here's the key price zones to watch. Immediate resistance / mean reversion zone, 595 to 605. That's where the 20-day EMA, 50-day SMA, and some Fibonacci retracement levels cluster. If QQQ can reclaim that zone, it suggests the correction is contained and we're back to choppy, but ultimately bullish conditions. First major support, 558 to 560, that's a multi-touch prior support level. As long as that holds, the correction is still orderly. Then the structural line in the sand, the 200-day moving average at 542. If we break that, especially with heavy volume and continued distribution, then we're talking about a potential regime shift. Right now, price is sitting right on the recent swing low at about $585. So we're at a decision point. But how do you tell the difference between a healthy correction and the start of a real meltdown? Well, just my personal take. And remember, I'm just a random guy on the internet who could be biased and very misleading. The base case right now is violent correction, not meltdown. And here's my reasoning. We're still above a rising 200-day moving average with an active golden cross. The drawdown is 8%. Normal corrections are 5 to 10%. Bear markets and crises usually start pushing you 20 to 30% down. The macro backdrop is mixed, not catastrophic. Labor is cooling but not collapsing. The Fed has already cut once and is ending QT, which is net easing on liquidity. Thursday's move lines up with a positioning and valuation reset in crowded AI and tech names, not a credit event or funding accident. So for now, this looks like a flush in a still intact bull trend. But what would flip that? What would make my thesis look like a joke? First, the technical damage. A clean break and close below 558 to 560 with another big volume spike, strong negative OBV, and follow-through selling toward the 200-day without a fast recovery. If the 50-day starts rolling down and you head toward a death cross, that's bad. Then the macro going the wrong way. Unemployment steadily rising into the high fours while inflation stays sticky. That's stagflation risk. Or treasury yields spiking on inflation scares and credit spreads widening at the same time. That's stress, not just defrothing. Last, the narrative break in AI. If the hyperscalers and cloud megacaps start explicitly cutting AI capex. Right now, Nvidia demand is still strong and guidance is solid. But if that story breaks, tech is in trouble. If you start to see technical damage plus one of those macro or narrative breaks at the same time, that's when you relabel this from correction to potential cyclical top. So here comes the natural question. Is a year-end rally still on the table? Short answer, yes, but it's conditional. And here's what supports the rally idea. First, seasonality. Late November through December is historically favorable for US equities. The Fed is already in cutting mode, 125 basis point cut done, and they're ending QT on December 1st. That tends to ease liquidity headwinds. The AI and tech complex has already defrothed 10 to 15% from peak levels. That eases some of the bubble pressure. But of course, there are a couple of things working against it. The most obvious one of all is valuations in AI and mega cap tech are still rich. Every macro wobble reignites the bubble talk. Then the data vacuum we mentioned. No October jobs report means each new print or Fed comment moves markets disproportionately. Also, elevated realized volume and VIX keep systematic strategies and volume targeting funds underallocated to risk. That means dip buying isn't automatic like it was before. So here's a simple checklist to monitor. A bullish price action for QQQ, which is we'd get a stabilization candle, a hammer or doji somewhere in the 575 to 585 zone, then a reclaim of 595 to 605. The bearish scenario would be a strong daily close below 560 with heavy volume and further OBV deterioration. Then the macro prints before the December FOMC. A good enough scenario would be inflation drifting sideways or down, labor softening but not spiking. Bad scenario would be inflation reaccelerates or labor cracking fast. Fed tone at the December meeting is rally-friendly if they frame cuts, plus QT ending as risk management in a still okay economy. But bearish if they sound visibly worried about persistent inflation or rapid labor deterioration. And again, like I said in my previous video, don't expect a clean V-bottom recovery. Expect choppy 2 steps forward, 1 step back type of action. Also, I'm not trying to be a perma-bull here. I might be wrong. But that's what the evidence on the table and my metrics are telling me right now. If you still find this useful, consider subscribing. I'll keep doing these as long as people find them helpful. Okay, that's all for now. DataCat out. Stay safe and stay sharp out there. I'll see you in the next one.